Hi everyone, and welcome to episode 6 of the Introduction to Forex Trading series. During this episode, I'm going to be walking you through the different ways that we can go about entering and exiting the market. We'll be exploring the individual components of a trade, the two styles of trade execution, and I'll also be explaining the different types of pending orders which you can use to have a position be automatically executed for you at a certain price. If you're a beginner trader, once again, this is going to be a very important episode, because entering and exiting the market is a fundamental component of successful trading. In those early days, a lot of the mistakes that get made by new traders are related to incorrect trade entries and exits. So by focusing during this episode, you'll be setting yourself up to completely prevent these beginner mistakes. So with that said, let's get into it. Every trade needs to have 4 predetermined components before the position can be entered into live markets. These 4 components are the trade direction, the trade entry price, the trade stop loss, and the trade take profit. If you're entering into the market and you don't have these 4 essential criteria in place, supported by a predetermined numerical edge, then you have drifted into the dangerous territory of gambling as opposed to trading. If anyone is unsure what these 4 criteria mean, don't worry, because we're about to walk through it one by one. First of all, you have the trade direction. Trade direction is simply an indication of whether you intend to buy or sell the market. This will be determined by technical confluence factors on a trade-to-trade basis. Second, you have the trade's entry price. The entry price is simply the price of the market when you first enter into your trade. Third, you have the stop loss. Your stop loss is an automatic trade exit order placed at a predetermined price point. The stop loss is essential because we need to automatically close out our position when we determine that our statistical edge has not played out on any individual trade. So what the stop loss will do is remove your position from the market at the predetermined price point. And finally, you have the take profit. The take profit is the opposite of a stop loss. It's an automatic trade order placed at a predetermined price point which will close your position. The purpose of a take profit is to automatically close a trade once the edge has played out. I'm going to provide a super basic example here. If you are buying 10 ounces of gold at a price of 1,000 and your take profit is set at 1,200, what would happen behind the scenes is that when price hits 1,200, your position would automatically be taken out of the market. Those are the 4 components of a successful trade. Every trade needs to have all 4. Now, as a new trader, it would be very important for you to have a checklist to make sure that all 4 criteria are present before entering a trade. If you can simply follow that one piece of advice, you will prevent many beginner mistakes. When it comes time to enter a trade, there are 2 methods which we can use. We can either execute a position in real time, or we can automatically execute a position using pending orders. The first option is called market execution, and the second option is called a pending order. When using market execution, you place a trade either long or short, and the broker will put you into the market at the best possible price it can offer at that moment in time. So the key point is that you press the button and the position gets entered straight away. In practice, how this works is that if you're buying, the broker will match your position with a seller that can offer the instrument at the price closest to your execution price. And if you're selling, the opposite occurs. The broker will match your position with a buyer, once again at the price closest to your execution price. Market execution is a very popular style of execution, but we do not believe that it is the best option. The major downside of market execution is obviously the fact that you may miss trades from time to time if they occur when you're not directly paying attention to the charts. Next up, there are pending orders. There are 4 types of pending orders. These are buy stops, buy limits, sell stops, and sell limits. I'm now going to explain how each order works, and you can actually refer to the image on screen for a visual explanation. A buy stop is used to buy the market automatically when price is above the current price point. This could be useful for scaling into aggressive buying momentum. Then we have a buy limit. A buy limit is used to buy the market automatically when price hits a certain point below the current price. This can be used to automatically buy in high confluence reversal zones. Next up, we have the sell stop. A sell stop is the opposite of a buy stop. It can be used to sell the market automatically when price is below the current price point. This could be useful for scaling into aggressive selling momentum. Finally, we have the sell limit. A sell limit is the opposite of a buy limit. A sell limit is used to sell the market automatically when price hits a certain point above the current price. This could be useful to automatically sell into a high confluence reversal zone. In our trading, we will use buy limits and sell limits. Before we wrap up this episode, there's actually one more bonus trade entry requirement that you're going to need to understand as you become a more advanced trader. You'll notice that when you're executing your trades on TradingView, your positions get automatically sized based on your account size and risk percentage allocation. This is undoubtedly a very nice feature, but when you start to move into the more advanced trading platform of MetaTrader 4, you're going to need to calculate your own trade sizing. Fortunately, this is very easy, and I'm about to explain exactly how to do it. Trade sizing is measured in something called a lot. One lot equals 100,000 units of the currency which you're trading. There are also some other terms such as mini lot, which represents 0.1 lot or 10,000 units of currency, and micro lots, which represent 0.01 lots, also known as 1,000 units of currency. The lot size you use to enter a trade is going to depend on three factors: the size of your account, the percentage risk per trade, and the size of your stop loss. We recommend always executing your positions with a fixed risk of 1% or 0.5%. So this narrows the calculation down to two variables each trade. To help with this calculation, we'll simply use a lot size calculator. Below this video, you'll find a link which you can use to find the lot size calculator. We would recommend adding it to your favorites. I'm now going to briefly jump over to my screen and show you exactly how to work this lot size calculator. Okay, so here we have the MyFX book lot size calculator, and it's all pretty simple. So pretty much what we'll need to first do is just select our currency pair. So we'll just go with Euro US dollar because we do commonly trade this pair. And then you'll have to select your account currency. So again, USD is another pretty common one here. Then what we'll need to do is enter our account size. So we'll just say that you're trading on a $200,000 FTMO. Next up, it's the risk ratio, which is actually just referring to how much risk you want to enter in a specific trade. So usually 1% would be pretty appropriate here. And finally, the size of your stop loss. So we'll just say it's a 4 pip stop loss. And then what we're going to do is go ahead and hit calculate. Now in this case, we'll see that it's a 50 lot trade, which it's pretty common on a $200,000 FTMO when you're trading smart money strategies. So now that you have this figure here, all that you would do is enter it into your MT4 terminal when you go to enter your position. And that's all there is to it. Super simple, super easy to do. So remember to go ahead and grab the link below this video and just put it in your favorites bar because in my opinion, this is the best position size calculator out there. So those are the basic concepts you'll need to understand when entering and exiting the markets. Here at Alchemy Trading, we personally focus on an advanced form of trading which is called smart money trading. One of the advantages of smart money trading is that it allows us to identify our trades before they actually occur in real time. This allows us to use pending orders. We personally view this as a major advantage over market execution because it provides us with plenty of time to get our positions into the market and allows us to get the exact price we want. We'll be talking much more about this in our advanced education content and in our smart money versus retail trading case study, which comes after this series. So thanks for tuning in, and I'll see you in the next one where I'm going to be discussing the different Forex trading sessions. Thank you.